The most important questions that advisors should ask their clients really get to what the charity is going to be asking the advisor when the charity is approached with the gift. So to go ahead and head some of that off, I think is particularly important. The big question is, what is the property and what is the value of that property? And while that sounds simple enough, usually you always ask the follow-up question, and how did you arrive at that value? And by listening and not talking, that can tell you a lot about what the true value of that property is. If they were to say, my brother in North Dakota told me that was the value, versus I've had a qualified appraiser take a look at it 2 weeks ago, that lets you know a lot about the value of that particular gift. The second most important question by far is, who owns the property? And donors are particularly bad about saying that they own the property no matter what or who owns it. And in some examples I've actually asked, who owns the property? They say that they own it. So I always say, if I look at the deed, I'll just see your name on it. They will say, well, actually it's myself and my wife, or myself and my wife in a trust, or an LLC, or an S corporation. Almost never are these assets individually owned. So to make sure that that's clear as to who owns the property has some pretty major tax implications and also design implications as it relates to which sort of charitable gift would be most optimal for that particular donor. Another question that I think would be important for advisors to ask is there any debt on the property at all? So debt can trigger bargain sale issues, acquisition indebtedness issues. So just knowing whether or not the debt is on the property or not will be very important as part of that planning process. Another one would be fairly simple, and that is, does the donor wish to make a partial interest of the gift or an entire interest of the gift? Too often people think what I say, that they have to be too charitable, and that is they have to give away everything, when really that's not the case. I would say at least 3/4 of the time these kinds of gifts are partial interests. So perhaps the donor might give 10% of an apartment building. They'll keep 90% for themselves. When it then goes to sale, 10% of that goes to charity. Donor gets the full fair market value deduction for that 10%, no capital gains on that 10%, and then they've created a charitable bucket that they and their family can then make as gifts both this year and certainly into the future and potentially in perpetuity. So that would be another question that I would want answered. Another question I would have would be the potential buyer status, and that is there a buyer in the wings or not? And that really goes to the transfer timing. Sometimes I'll ask, when would this be most conducive for you to make the gift, or when do you want to make the gift? And if they say this afternoon at 2 o'clock, in many cases that gives me a bit of pause, saying, why is that the case? And too often, many times they will say, we have a buyer in the wings, or a buyer that's already signed everything, all the documents are complete, and closing is on Friday, so we need to do this very quickly. And obviously then that's not going to be a very good gift from a prearranged sale perspective. So that's something that we would want to know beforehand rather than we get too deep into it. Another question I would want to know is whether or not the donor wished to make the gift as an outright gift, whether that's an entire interest or a partial interest, or whether they wanted to make a gift, let's say, to a charitable remainder trust where they would receive income for their life and perhaps a spouse's life, or whether they would want that to be a testamentary gift. So clearly that would be generally a will or bequeath provision to the charity. So those kinds of questions would be important to know. Not only are we talking about which asset and is the asset conducive, but actually the vehicle, outright gift, life income gift, or testamentary gift is certainly important as part of the planning process. Another question to ask would be whether or not the asset actually is a capital asset, so whether upon sale that would be capital gain, or whether that's an ordinary income asset. And usually that's pretty clear cut. Whether it's a real estate, typically that's going to be capital gains tax or closely held stock. But for ordinary income, sometimes advisors get tripped up primarily with insurance policies, whether that's life insurance, annuities, and also with stock options. In many cases, non-qualified stock options will trigger ordinary income tax. And unfortunately, for anything that would be ordinary income, it's going to be the lesser of the fair market value or the basis as the deduction. So it can still be an important gift to make, but usually those are not the best gifts. You'd want a long-term capital gain asset, ideally, to make that gift.